Well, 2 down and 1 to go. South African government bonds weakened earlier, as we reported, and that's after S&P Global Ratings on Friday downgraded the country's local currency debt to sub-investment grade. For normal people, that's junk, while foreign currency debt was pushed deeper into junk territory. Moody's decision to only place South Africa on review for downgrade has brought some relief to the currency, but the country's next event risk is December, that ANC December elective conference. Joining me now to discuss the impact of South Africa's recent credit ratings downgrade and the impact this will have on the wider economy and retail-facing stocks, we are joined by Annabel Bishop, Chief Economist at Investec, Lesiba Mothata, Executive Chief Economist at Alexander Forbes, and Michael Treherne, Portfolio Manager at Vestact. Lady and gentlemen, good afternoon. Right, so we've all had some time to digest the statement out of S&P Global Moody's. It looks like the market didn't really care much if we look at what the rand was doing, but I'd just like to ask for everybody's thoughts on what they had to say. Lesiba, let me begin with you.
There's a form of efficiency in local markets. This really was in the offing for some time. Over 18 months, we've been expecting a downgrade. So you can see already in what we call credit default swaps market, which is a derivatives market that trade interest rates. In there you would find already, we look at Brazil, like Turkey. So this was in the offing and well expected. It is, while the market outcome is muted, the outcome is dire. The economic consequences are very significant. And therein is a concern that there doesn't seem to be an imminent solution put on the table to plug this hole. It's very discouraging to see that we actually still have the medium-term budget policy statement as put out, because that guarantees further downgrades deeper into junk.
The market output or the market reaction to the downgrade being muted, Michael, what does this downgrade mean for you and making clients money in this environment?
Yeah, I think it was priced in, was expected, and I think market was actually expecting Moody's to really put us down into the junk status as well. I think what's important is context in the matter. And if you have a look at Brazil, who would be considered a similar country to us, albeit a lot bigger than we are, they're really 2 levels below junk. So that's where their bonds are, and their bonds trade at about 10% yield on their 10-year. So our 10-year is at 9.4%. It's not the biggest gap from 9.4 to 10%. So even though we're going to be pushed into junk more than likely after our February full-year budget statement by whoever is finance minister at that stage, the market's already priced it in. The rand didn't move too much. It just shows these market efficiencies.
Annabel?
Sure. So I think we actually saw a very slight strengthening of the rand early this morning, and I think that was a bit of relief that we didn't get more than the 1 downgrade. You know, as has been said, it certainly has been priced in quite substantially, and indeed, if you look at the CDSs, they've actually been running on a BB+ rating. So I think, you know, the point really is that maybe quite rightly, Moody's decided to wait until after the ANC elective conference and the budget next year, so that, you know, if perhaps they did get an outcome which was perceived as very favourable by the markets, they wouldn't have to change around. But Moody's is also typically quite slow to make judgments, and I think now we're basically sitting and waiting for April 2018, which is when Moody's will deliver its next country review.
I mean, Lesiba, when we caught up a couple of weeks ago, you had said that you were expecting this. In fact, you said you'd be surprised if it didn't come. But were you expecting S&P to downgrade us on our local and downgrade us again on the foreign? Is that significant?
That's very significant. I did not expect the foreign further deterioration. Well, we're encroaching single digits, you know, single alphabets soon, which is closer to Nigeria, which is problematic. It means that there's such a deterioration that the cost of capital will actually have to go up now. Lesiba at the Reserve Bank has confirmed that he's thinking about increasing the cost of capital from a monetary policy perspective. Already, for every rand we're earning from the fiscus, 15 cents are paying interest. That can easily go to 18, can easily go to 20. The situation needs to be halted. And that was a surprise that we're actually deteriorating faster than I thought.
And I understand that we are much closer now from being ousted from that WIGB index, but apparently we've been ousted from the Barclays government bond index. I don't know how significant that is. Annabel, perhaps you'd like to comment?
I think, in general, maybe we should just take a step back and
Sure.
see, what's actually happening in financial markets. And globally, we've got a very strong risk-on phase, so that's something to really bear in mind. If you have a look at an analysis of other countries who've been through a downgrade from investment grade to sub-investment grade, if you look at Russia, if you look at Turkey, Brazil, Hungary, they saw quite substantial impacts on their bond markets, on their currencies. And, in general, when you get credit rating downgrades, it tends to have a less severe impact on financial markets when it happens in a global risk-on or risk-taking period than it does on a global risk-off period. We're in quite a strong global risk-on period. So I think to some extent that has actually dulled the impact. And, perhaps it's a little bit concerning because it makes people feel, well, maybe credit ratings don't actually matter.
Exactly.
That's a bit of a worry because we
Exactly.
haven't seen a big reaction on the financial markets. And everyone's been saying it's such a scare story. There will be a big major reaction. So that's really, one of the problems. Now, if we were in a global risk-off environment and we had these credit rating downgrades, you would have seen more impact come through. Risk-on means investors like to hold assets, debt of emerging markets, equities. Risk-off, they want to sell all of it. So obviously, it's actually been smoothed to some extent, and we may see some reaction, later in the month, certainly. But basically, the big index, the WIGB from Citibank, that's still to come if we fall out of the investment grade category as a consequence of a Moody's downgrade in April next year, and we'll have more of an impact then.
I mean, Michael, do they matter in terms of financial markets and in this environment of risk on for the kind of companies you hold in your portfolio?
Yeah, look, I think from a company-specific basis, it's less burdensome. I think the 2008 financial crisis deeply impacted credit ratings, reputations in general, where they said a whole bunch of stuff was AAA rated, risk-free basically, and then they went belly up. So that hurt their reputation quite a lot. But I think as you're moving forward, it's more from a overall regulatory perspective, where if you own a bond index and you can only own investment grade, then obviously what the ratings agency says matters. In the case of the Citigroup emerging market bond index, both S&P and Moody's have to downgrade you to junk to lose that classification. So I'd be interested to see what happens when and if Moody's does downgrade us. What is the reaction? Because as much as the stuff is priced into the market, if you're an index tracker, you can't take foregone conclusions on anything. You have to react once something happens. You can't do it anything beforehand. So,
but as an active manager now, what does this mean if somebody's looking and asking, okay, should I be selling companies in the retail sector, in the banks, because they mainly they derive the bulk of their profits from here? What would you be telling those individuals?
Yeah, so our general approach is to be diversified across sectors and across jurisdictions where you will operate. And that the JSE gives you a lot to do in the sense that you have a look at our top 10 companies, top 10 biggest companies in the JSE. The majority of them, if not 50% of their earnings, are offshore. It's close to that number. So you have that diversification aspect. There is a bit of the concern around the retail sector. If the rand deteriorates further as people start not investing in our debt, then you start seeing imported inflation, and then with imported inflation, you see the monetary policy have to act in the sense that they have to raise interest rates, and then obviously it has a whole bunch of knock-on impacts that's not great for the retail and banking in general.
All right. And Lesiba, you did touch on the Reserve Bank slightly there. I'm assuming you were saying that interest rates are likely to go up as projected in that model in the SARB's governor's speech last week.
Which was new.
Very new.
I've never
complicated.
seen it since 1994. The MPC has never spoken about such a model. It was telling, perhaps they had the information before we all had about ratings downgrades. It's very possible. But in it just shows that cost of capital is going to go up here. In their model, although they show that the inflation is going to be in the target range over the forecast period, they may be forced to hike interest rates if you get a disorderly outcome, because the event risk of December is very huge. If you get a candidate who is not well favored, at least perceived not to think about the economy in a productive way, who can deteriorate the whole situation of state capture, etc., you may get Moody's, along with the other two, responding all over again with further downgrades as one continues, which can prove problematic. Under that scenario, you get the rand blowing out, you get inflation being elevated, and they may be forced to hike interest rates.
Lesiba, let's put a pause on that for now. We have got S&P standing there on the line. Now, S&P grabbed headlines after downgrading South Africa's local debt to junk and foreign debt further into sub-investment grade. Ravi Bhatia, who's the director of sovereign ratings at S&P Global, join us now. Ravi, thanks so much for your time. Some might argue that S&P was a bit tougher on South Africa, given that your peers didn't quite make a ratings adjustment waiting for December. Perhaps you can motivate the reason for the tough stance S&P has taken.
Yeah, well, I mean, you know, we saw the trajectory and the numbers in the MTBPS that was published, and really there was quite a significant deterioration in public finances, and also in the growth numbers. And, you know, looking when we did our own assessments, really at the core of the story is that the growth story has been really very poor. If you look at it on a per capita basis, actually per capita GDP has been going down instead of up over the last few years. So it's a very poor growth story. And on the back of that, fiscal revenue story has also been very poor, and that hit the bottom line fiscal. You know, the numbers are really quite bad. I mean, the question was, well, can they really turn this around at the next budget? But I think our view was that it's really quite really a very difficult task because the underlying issue is around growth, and it won't be so easy to turn around. So we took the action that we did.
So it's essentially a double downgrade from S&P on the local and the foreign, yet you've raised our outlook to stable. Perhaps you can help us understand why.
Yeah, sure. I mean, the stable, you must understand, it's in the context of being in a lower rating category. So our risk perception changes when we move down into a lower rating category. Basically, we consider it more risky. And then in the context of this new rating category, we have a stable outlook. So it's like that. Basically, we've moved down, and now at this risk level that we're willing to accept for this credit rating, we have a stable outlook.
And Ravi, lastly, we've just had breaking news that the mining charter will be postponed. The finalization of the mining charter will be postponed until February 2018. Your view on this, is this a ratings negative or ratings positive?
Well, I mean, we've been watching the mining charter, and it's been a rather drawn out process. And I think this is more broadly, you can look at it in the context of more broad reforms. The reform measures have not really delivered a turnaround in the growth story. Part of it is that, you know, they're taking time, and there's been really a lot of discussion and not that much delivery. But really, at some point, you know, the country would need tangible reforms which would turn around its growth story, rather than this sort of very long discursive process.
Well, Ravi, thanks so much for your time. We'll leave it there. That was Ravi Bhatia of S&P Global. The mining charter is postponed. How are you viewing this?
Well, you know, it's an interesting document, not well received in the industry. It has dampened confidence in an industry that needed to be boosted in terms of clarity of laws, etc. But the detail of that charter is interesting because it is talking about local content. It is talking about transformation which is needed, and the targets about transformation are reasonable. It's just the acrimonious relationship that ensued between the minister and the industry that has resulted to where we are now. So more uncertainty, less clarity, not good for investments. Confidence is very weak now.
And yet you've got players like South 32 that are announcing major deals, given that uncertainty in that space. Michael, your view on South 32's proposition?
Yeah, look, I think they're taking what they've got, and they're working with it the best they can. I think the point that there is uncertainty is not great. I mean, if you're deploying long-term new investments you're not quite sure where you sit, particularly into new mines. Existing mines and extending life of mine is a lot easier because it's already there, the infrastructure is on the ground, you know what to expect reasonably well. But delaying it is not great. So you do want to see certainty coming through. I think particularly on the once empowered, always empowered topic, which this mining charter doesn't touch on. But as long as you've got some sort of certainty to work from, then you can work on to the next one and move from there. But it just shows it's not going to be a quick fix.
I mean, if we have to start talking about solutions now, so we're here because our growth is too low and our debt is too high. So growth needs to come. Where can it come from in this environment?
Well, I think, you know, that over the last few years, several years indeed, we've seen a downward trajectory in economic growth. And it's really come about due to the depressed nature of business confidence, because certainly business confidence does feed through into the economic growth cycle. It feeds through into investment. And of course, we've obviously seen this deterioration in fixed investment as well, partly because economic growth is weak, and why would you expand capacity in a weak economic growth environment if you expect it to continue? But also as well because of the political uncertainty, the economic uncertainty, because of the deterioration in government finances. And if you have a look at other countries in the world, and it's quite prevalent in sub-Saharan Africa, when you see government finances deteriorate, you see a negative impact on business confidence. And that certainly has been one factor which has been quite detrimental for South Africa's economic growth. And if you have a look at the actual fiscal metrics themselves, you know, we've basically seen caution thrown to the winds in the medium-term budget policy statement, where they hike up the debt to GDP ratios quite substantially. And that's really not sustainable at all. And that was quite clearly met with the comments from S&P and their concerns around it, because ultimately the credit rating agencies just assess your creditworthiness or your ability to pay back debt. So if you're going to be increasing issuance in a low growth environment, in other words, your revenues are not going to perform particularly well, then obviously they have quite substantial concerns. So I think the risk we really face now looking forward is if government perhaps overdoes it on the tax increase front and thinks we can just, you know, do major tax increases now to solve the problem, and that'll just further depress economic growth even more and actually probably cause some companies to look to move offshore, even individuals, where perhaps tax regimes are actually better positioned for economic growth. You know, so really we've had quite a structural issue in South Africa, and it's really impeded us in the last several years. And I think turning that around now, we need to be more cautious on our government finances front. We can't just project a whole big increase in government debt because, you know, we feel we need to, you know, have a lot of cash to spend. In fact, we actually need to reduce our expenditure. You know, and instead of saying we're putting expenditure ceilings in, which are a cap on the growth in expenditure, we actually have to cut expenditure itself. And in the absence of cutting expenditure, you know, we're going to be at risk again next year.
And Lesiba, to take it back to December, I think it was S&P that noted concerns of populist policies that were not necessarily accompanied by growth-enhancing measures. I imagine they were talking about radical economic transformation, although they didn't say it.
It could have been that, or it could have been just also the whole idea about developmental state. Okay, we have state-owned enterprises which are committed to be bailed out because they serve a particular ideology. They could be talking about that too. But looking at the candidates that are put out, I'm yet to find an economic policy that comes from the other camp. There was clear policy directive that came from Cyril, who talks about the New Deal, etc. Perhaps the other side will bring in some ideas. But, you know, we talk about economic reform, we talk about growth. He thinks 3% in 2018 can be achieved, which I think it's very, very interesting. But if you sort out confidence as discussed...
Hold up, so from 0.5% this year to 3 in 2018.
So
right.
The next, that's what's coming out. But if you sort out confidence, we're having a tailwind from the globe, and if you stop the downgrades, meaning you have lower inflation sustained longer, potentially with interest rate supports, lower interest rates, then you can get the consumer continue to add. It doesn't look impossible, but it does leave one wondering if it can be done in the next 12 months. But it's noteworthy. We need to think about that.
Yeah. And I think education as well. Our poor education system was also highlighted by the ratings agencies as contributing to inequality and poverty. And Michael, my question to you is, in terms of addressing the skills gap, should some of our companies perhaps be doing more to inject their funds into uplifting education? Annabel, I know Investec does quite a bit of work in that light, but is this also how we can get out of this skills gap?
Yeah, look, I think everyone needs to do their part, but I think it's worth noting, though, that companies pay their fair share of taxes, and those taxes, it's up to government to spend those efficiently. And I think you've almost reached a stage where the amount of money being spent and what's coming out the other side are not in sync with each other. So more money thrown at the problem probably won't solve the problem that's there. I think it's PSG who focuses on, we'd rather pay a good dividend to our shareholders and let our shareholders decide what they want to do with it and give to the charities that they feel need the money. You remember, your first and foremost, your company's job is there to make money for shareholders. And if part of that strategy is to be a contributing member of the society, then that's their strategy. But if that's not their strategy, then that's not the end of the world either.
Mm-hmm. Just some closing comments, because we do have to start wrapping up. Annabel, closing comments from you.
Well, I think I mirror what's being said, that I'm greatly concerned that we just carry on down the ratings ladder. You know, we started AAA at the top, and we've moved out of the A category into the triple Bs. And now we're moving out of the triple Bs into the double Bs, and I'm worried we keep going down. You know, eventually you can end up with C, D, and I think that's the risk. You know, that's the eventual risk that we face, that if you fall into a debt trap, where you see your debt levels escalate, your repayments on the debt, your interest on the debt escalate, and eventually, you know, you're taking out debt to pay the debt, which is what government's been doing when it's actually, you know, been running a primary deficit. These are the big issues we face, and you can actually eventually move yourself into a debt default territory. So I don't think that we're in a good place at the moment. I don't think we can say, oh, we can relax, you know, we only got one downgrade. I think it's actually pretty chilling. And I think, you know, the fact that they did that foreign currency downgrade, as Lesiba said, is very, very worrying, because it means that they are considering further drops down the grade. And eventually, you know, if you become one of those single-digit B countries, your investment levels do dry up, and it becomes quite a difficult situation.
Lesiba?
We've got to get out of ideology. This problem we have in South Africa is self-made. Those in authority chose a particular ideology. They're hell-bent to bring this country down, and that must stop. Yes.
And that must stop. Michael?
Yeah, I think it comes down to the spending that we do, and it needs to be more efficient. I mean, I think in the medium-term budget, it showed we spent, I think, 9 billion rand on transport for government officials. It's mind-blowing how you spend 9 billion rand on something like transport. But it's not the end of the world where we are at the moment. If we keep going, it's a problem. The one graph that's chilling from the medium-term budget is the old expected debt to GDP graph and the new one. The old one got to 2018, 2019, and it peaked out at 52.9%. The new one says we're not going to stop anytime soon, and by 21, 22, we're going to be at a 60% debt to GDP. Now, government can turn themselves around, but if you've got a massive overhang of debt that the previous administration got you into, and the 15% interest that we pay every year of our GDP just on interest, it's monstrous, and that then hamstrings you going forward, and decisions we make today will have impact for the next generation.
Well, thanks so much for those insights to everyone. That was Annabel Bishop, Chief Economist at Investec, Lesiba Mothata, who is the Executive Chief Economist at Alexander Forbes, and Michael Treherne, Portfolio Manager at Vestact.